Hey, everybody. My name is Jeff Gibby. I'm joined by John and Jack Kosar. This is their third time in. They did a really good job the last couple of times, so I keep bringing them back. I was telling them right before we started, they've probably had the biggest impact on my trading of any of the guests we've had to do a market talk. And I'll talk a little bit more about that. As we get started, though, I do want to read a legal disclaimer because it keeps my lawyers happy. So today's demonstration is designed to instruct you on using Metastock and the accompanying software plugins. It's not a recommendation to buy or sell any securities, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock, the Traders Forum, their employees, their guests disclaim all liability for investment decisions by investors based on the use of the software, trading strategies, or information provided in connection with the company. Metastock, the Traders Forum LLC, their employees, and their guest speakers do not endorse the purchase of any security, nor are they paid to promote a security. No information contained in the presentation should be construed as investment advice or the solicitation to buy a security. And if you've been to any Ticker Talks before, welcome. As you come into the room, say hi if you're watching this on YouTube. Make sure to like and subscribe. It helps a really good deal. So we are the tradersforum.com. You should join our community. It doesn't cost you anything. You can chat it with other traders. There's tons of resources to learn about technical analysis, candlestick patterns, the markets. It's a free community. We put it together as a community to help traders help other traders, I guess. www.thetradersforum.com. I invite you to come join us. So also our guests, John and Jack today, you can find more about them at asburyresearch.com. Their phone number is 888-960-0005 and info@Asbury Research if you ever have any questions. So we're going to go ahead and get started there. I do want to introduce our guest today. I'm going to go ahead and kind of just let me figure out how to stop sharing my screen. Oh, there we go. That was easy. All right. It's like I've done it before. Our guests, John and Jack Kosar, this is their third Ticker Talk. And I said it a little bit earlier, but one of the things that really was interesting to me last time is do you remember exactly the timing of the last one? Like it was February maybe or March? It was just a little bit ago.
I don't recall, but I know that area that you're talking about because that's when you saw a lot of accelerating relative outperformance by non-U.S. equities. It started in Western Europe, and then it just kind of expanded from there.
Yeah. So and at that point, you had been risk off for a while in the U.S. markets. I think
since the 21st of February. Yeah.
21st of February. Okay, so it must have been in March. But you were talking a lot about kind of the European assets and kind of some of the European ETFs. And since you talked a little bit about those, I added them to my watch list. I was like, that's a really good idea. I don't know why. I didn't even know they existed. So thank you for that. Those have actually been outperforming almost anything else in the portfolio that I have right now. And welcome back. Do you guys want to spend a couple minutes just talking about yourself? If I'm not.
Sorry?
I said, do you want to talk a minute about yourself and just kind of introduce yourself since I didn't?
Yeah. So this is my 43rd year in the financial business. I started on the floor of the Chicago Mercantile Exchange as a runner when I was 24 years old in 1980. And I didn't know anything about markets or anything. I used to weightlift with a guy at a YMCA. We used to spot each other on the bench. And one day I saw him get into a $60,000 whale tail orange Porsche Carrera. And I asked him what he did for a living. And he told me. And he said, why don't you come to work for me? I was a kid. I didn't really have anything. I was trying to figure out what I wanted to do with my life. And driving an orange Porsche seemed like a decent idea at the time. So I went over there and spent 17 years there. Left the floor in the late 90s when it was apparent to me that the floor was slowly going away. And not a whole lot of other places are there on earth where you can make a living doing this all day, right? That's basically standing in the pit, right? And, when, quoting the bid and offer, which is what we all did down there, filled orders and, facilitated business down there. So left the floor, went to work at a couple of firms, opened Asbury Research in 2005. And last year, 2 years ago, this is my son, Jack, as you know, he came to work for me full time, but had been working for me part time for the better part of a decade. We built financial markets together. I always tell people, like, some dads might go fishing or golfing. It started out as a fun kind of academic exercise for us, and turned into a business. And we started managing money about a year ago. So we're managing money for some RIAs that are giving us some of their AUMs, and we trade our models. And we also I've been doing educational webinars for Fidelity Investments for more than a decade. So we've accumulated a following of older, wealthier, and more risk-averse investors that we've also started to manage money for. And then IBD, I've been all over the place lately. I don't know, I got a little more famous late in life, but I'm on the Schwab Network once a month. We get interviewed by IBD a lot. And so it's nice to be seen, like I always say.
Awesome. Do you actively take more assets under management? If that's something somebody's interested in, they can reach out to you?
Yeah, we're growing. We're growing quite a bit. We have four different model portfolios that Jack and I designed together. And so I'll let Jack talk a little bit about his background. But I didn't go to college. Don't tell anybody, but
it's our secret.
The old guy over there, he never went to college. So my college was 17 years on the floor of the Merc. Mm-hmm. And I wanted my kids to go to college, and Jack did, and he had a very outstanding academic career and a pretty good sports career too. But I'll let you tell him.
Yeah, so I think officially started working for Asbury about 2 years ago, but I've been helping out with the company probably since I was 10, 11 years old. Starting off with some simple Excel spreadsheeting and helping with some technical software stuff, and have went off to school, got a master's degree in finance, and just been the last 10 years kind of been floating around the financial industry, working for various insurance companies, tech companies, banks, and then finally decided we'd make it official and come over and work for Asbury. And again, we've been building models together for a while, but really nice to be able to kind of put our heads together. And we got a pretty good combination between experience in the financial markets from my dad, and then me bringing a little bit of the academic side of things. So it's kind of a good combination. We attack the markets problem from two sides, and hopefully are a little bit more right than we're wrong most often.
Cool. Great. Last time you were here, I'm going to kind of jump into it a little bit more here. Good. But last time we had you in, you kind of talked a little bit about the model updates and the strategies that you do. We had talked, if I remember right, about the CPM model and the CEF models. Those are something somebody can subscribe to. Is that correct?
Yeah. So if you're a research subscriber for us, you get access to the CEF model and the CPM signals. And then our money management clients have an opportunity to directly invest in those models.
Okay. Can you talk a little bit more about what they are?
Sure. CPM is the first model that we ever built. And the genesis of it was I had research clients that were managing other people's money, RIAs, all kinds of portfolio managers. We had some commodity trading advisors at the time that were with us. And what happened to a lot of their clients during the financial crisis is, generally speaking, people stayed too long. Typically, advisors don't do a lot of tactical trading, right? If you go to your advisor at ABC down the street, they're going to tell you that they're going to ask you a dozen questions. Based on those questions, they're going to say, you're a 60-40 stock and bond investor. We're going to set you up on that. We'll buy you a little bit of gold to protect you in case bad things happen, and maybe a little bit of international. And then it's set it and forget it, right? Like, the Ron Popeil commercials, you set it and forget it. And I never believed in that. So what happened with these customers is they stayed too long during the financial crisis and took most of that move down. I think it was about 35%. Mm-hmm. Then they finally got out the bottom, right? After you do the please God, I promise I'll never trade stocks again if you just get me out of here alive. And then they get out at the bottom, and then the market went up. We saved the car industry, and things changed in early 08. We had like a secondary bottom in March of 08 of that year. I could actually see that in my head. It was such an important bottom. And the market started to rally, and these same guys could not get back in the market because they had just gotten their heads kicked in. And they were like, oh, no, it was either the attitude, oh, no, you're not going to get me twice. And then the market came right back over time. And these guys, so they lost.
They locked in their losses. Yeah.
They locked their loss on the bottom, and they didn't have the wherewithal. And I've been there. I mean, this is just human nature. Like, if a bear is chasing you, you run, right? It's like built into our DNA that after you get your head beat in, you don't necessarily want to go right back in the ring. So they asked if I could build something that would just not move very much and be binary, risk on and risk off. And what the result of this was, the way we explain it to people, it's kind of a dynamic stock and bond portfolio, but instead of having your advisor set it up for you and then you let it run years into the future, set it and forget it, when the model tells us to be risk off, when the market tells us to be risk on. And by the way, we've been risk on now again since April the 23rd.
I was going to ask, actually.
Yes.
I was going to actually ask.
So we were risk off since like February 21st-ish. And when we're risk off, the assets in the model go to BIL. If you're not familiar, BIL is it's got a long...
The Lehman 1 to 3 month treasury note. It's essentially trying to track the yield on short-term treasury instruments.
Yeah, it's 8 to 13 year treasury yield. Right now it's 4.19, 4.2-ish. And then when it goes back to risk on, we sell out all of the bill and we buy SPY. So it's either SPY or bill, stocks or short-term bonds. So we're doing really the same thing that your advisor set you up for 3 years ago, but this is dynamic and triggered by market activity based on our model. So that's what the CPM does. The CEF model is a sector rotation model. So the CEF model tells you, should I be in stocks or bonds? Should I be offensive or defensive? The CEF model, Jack's had a lot more input on the CEF model. Actually, most of it's his, really. It was my initial idea, but Jack has really built this out. I'll let him talk about the CEF model.
Yeah, so we're attracting the 11 sector spiders and kind of it's asset flows and momentum. We're trying to figure out the velocity of money coming in and out of the 11 sectors over 3 different time periods. We create a ranking score. That ranking score is similar to golf. The lower your score, the better you are. And our model always takes the top 3. And our kind of underlying thought process is that there are a lot of investors that cannot go to cash, and they have to stay invested in the market at all times. And instead of staring at the price chart and trying to hope to see some trends, that we look at the underlying asset flows and calculate the velocity of how they're coming in and out, and seeing how managers are voting with their feet instead of with their mouths. Because sometimes you can watch a lot of financial TV and kind of get whipsawed and put off sides, because by the time you're seeing it on TV, it's already happened and gone and passed, and you're just chasing your own tail. So we track the velocity of money. We do a lot of work with the asset flows, how much the flows are coming in and out. I do a weekly video that kind of breaks down for our subscribers, breaks down those individual asset flows. And in general, over the last 8 years, we have the CEF model has identified the top sector, returning sector each year. And in general, it puts us where we're supposed to be. We also use that model for some of our clients as an indicator. The sectors that are at the top of the model tend to do outperform. They relatively outperform, but the ones at the bottom tend to relatively underperform. So we have some clients that are managing their individual stock portfolio by looking at our CEF table that we have that kind of says, okay, well, we start to see tech falling off. I might pull some of my exposure. Or I'm seeing energy rise from the bottom up to the top. Maybe it's time to add some on. So while it is a trading model, we have various uses for it to kind of help our clients with their investing. We bring the investing to them instead of force fitting them into our box.
Cool. I'm glad you mentioned that you're risk on again. I find that interesting. Can you talk about last time you talked a little bit about the I think you called them keys.
Jesus. Okay.
Yeah, can you talk a little bit about what those are, what they're showing you, and kind of what would need to change? Do you feel like there might be a possibility that you go risk off again in the near future?
Okay, so we'll go.
That's a lot of questions. You can take them one at a time.
It is. So we'll look at keys. But the question that you asked is an interesting one because basically, let's go to keys, because this way, while I'm talking, I can kind of point to certain charts. So let's see if we can bring that up here. I don't see it. Oh, it's over here. I'm going to have to click it. There we go. All right. Can we see that?
I can see that. Yes. Excellent.
All right. So
good job. First try too.
Yeah, especially for me. That's why Jack's here. Otherwise, I'd be fumbling around here until noon. So one of the standard reports that we do in our research, it's a weekly report. It's Keys to This Week. I look at a lot of data. I look at more data than most anecdotally. I mean, I've got a lot of friends in the business. I've been around for 40 years. We're very much connected to the CMT Association. And, you make a lot of friends in the business. Most people don't look at as much stuff as I do. Some people think less is more. I look at a lot of stuff. So what we decided to do, this is probably our oldest report, is once a week, we go through a lot of charts. And we decide which 10 charts are the most important for our subscribers to be aware of. What should they be watching? That's a hard thing with technical analysis that maybe a lot of people don't think about. But I mean, look at Equus. Look, there's a bajillion indicators there. Mm-hmm. There's so many indicators there. So especially for somebody that doesn't do this for a living, it's like a kid in a candy store, right? Do I want, the Tootsie Rolls, or do I want the Hershey? There's so many things. And I think it gets people sometimes too much. It's easy to get thrown off track because there's so many different indicators, so many different variations on a theme. So what we do is we pick out 10 that we think are really germane to market activity, and we publish those, and we put a couple of sentences together about why they're important. So, you had mentioned about, this is something that we were watching. MAGS is an ETF that tracks the MAG 7, right? There's an ETF for everything under the sun these days. Oh, yeah. But MAGS tracks the MAG 7, and the MAG 7 has been leading the market for some time. In fact, when the market has broken down here over the past couple of months or so, we lost leadership by a lot of the MAG 7. And that was a big part of the market having that secondary top in February and falling down. So the market's at a spot now where everybody's wondering, did we bottom on April 7th? Is that a real bottom? Are we still in a downtrend? Is this thing going to turn around again? You don't know. This is a really difficult period because the day-to-day gyrations of the market are oftentimes because of what new text or
news driven.
What news comes out of the White House? What are we doing today?
Driven.
Is Preston talking today? Is Trump talking today? What are they saying? Are we going to fire Powell? Are we going to keep Powell? Even with COVID, 5 years ago with COVID, we knew everybody was on the same page, right? Everybody wanted to help keep the economy afloat by stimulating the economy, whatever was necessary to keep the economy afloat, to keep people from, losing their homes and having to live in the street. And then the scientists were working 24/7 to try to solve this. So we knew at least that global ingenuity with science and the White House trying to keep the economy from going in the tank. We don't have that this time. It's different. We've 70, and this isn't politics. This is just facts. 70 or 80 years of global political relationships are all different now. Our friends are not our friends. The ones that weren't our friends, it's a food fight. So what you want to do is figure out what's been leading and is it leading now. So this is MAGS up here on top. This is the open, high, low, and close daily chart. Goes back to the end of last year. This is the AUM invested in MAGS, which is shares outstanding multiplied by NAV. Down here is MAGS versus SPY. How is it doing versus the S&P 500? So what we looked at last week, again, this is almost a week old, but note that on a 21-day basis, which is our tactical time period here at Asbury, starting to outperform the S&P. It's made a couple of fits and starts to try to do that earlier in March and earlier this month, but starting to see some relative outperformance. That's good. We want to see the MAG 7 start to lead again. We had Microsoft had just a blowout earnings report yesterday that has stimulated this nice rally we're seeing this morning. Here's that AUM. Notice the AUM was coming out of MAGS right here on a 21-day basis, starting the beginning of February and really through the middle of March. Now it's kind of oscillating back and forth, but it's moving back up above the 21-day moving average. So we're looking at this as a potential, I don't care what comes out of Washington. There's no way for me to handicap that. I want to know what the money is doing and where it's going relative to the MAG 7, which has been a really big market leader for a couple of years now. So that's one of the keys that we look at, kind of an unusual way maybe of looking at it, but that's what we do. Something else is, I don't have that chart in front of me, but something that we look at back in the early part of April, I don't have those charts, but in the S&P 500, I do have the S&P 500 here. Sorry, I'm whipping you all over the place.
You're all right.
But right here,
I'll let you know if I get dizzy.
So right here in the S&P 500, this is the January 22nd benchmark high that we had been watching all year at 48.19. And underneath it and coming up fast was the trend line drawn off of the COVID low, which was March 27th of 2020. So we were looking at this as a possible place for the market to either, if it could hold it, it could be a strategic bottom, a multi-quarter bottom. There were similarly important support levels also in the Dow 30 and also in the NASDAQ 100 that we were looking at. So we were watching this live as it was coming down, but we didn't know if it was going to hold or not. But one of the things that made us think that it might was, this is a percentage, let me make this isolated here. This is a percentage of NYSE stocks trading above their 200-day moving average. When it gets down under 10%, good things happen to the market. It's basically what it is it's exhaustion. It's negative exhaustion and market breath. You could see October 2008. That was right close to a pretty important bottom. August 2011, Jan 2016, December of 2018. This was COVID bottom right here in March of 2020. June of 22, we had a bottom after that was a little deeper, and here we are again. So what does that tell me? It tells me that unless things are different this time, and I've heard people call that the most dangerous 5 words. So we don't know what's going to happen in the future, but we can look backwards and say, what happened when the stuff was hitting the fan, when the market was freaked out? Everybody thought it was the end of the world. We had that during COVID. We had that during the financial crisis. Well, we've got it now. So we knew that we're coming into these big support levels, and we had this. And we also had similar sentiment readings that were similarly extreme. There was 4 or 5 different indicators like this that were telling us extremes. So what that allowed us to tell our clients is we didn't know if that level was going to hold here in the S&P 500. But we did know as it was coming into it that we were coming into some really extreme conditions, according to sentiment, according to standard deviation, according to what we're just looking at in terms of market breadth being washed out. So that's kind of what this weekly report does, is it shows our clients, our subscribers, what we're looking at. And you could see here, most of the factors were in the positive quadrant for a tactical. This is tactical up here. So it told clients coming into this week that things were set up for the market to do better.
Interesting. Cool. I'm curious. Thanks for being so generous with kind of the information and the reports and that kind of stuff. Have you made any changes to your models based on the volatility we've had this year? No,
we haven't. Our models are pretty robust. We are, Jack can talk about this a little more. He does the back testing, but we've agreed that on the time frame that we go back, and it's 5 to 7 years. And this past 5 to 7 years, we've had a change from a zero interest rate environment to a more of a normal interest rate environment. We've had a 100-year pandemic. We had an almost year-long major downtrend in 22. It's been a pretty robust 7 years of back testing. I don't know if you want to speak to that.
Yeah, we do review our models quarterly in terms of what are all the underlying indicators, machinations, rules, and things of that nature. And honestly, even with the increased volatility, all the models have more or less behaved how they were supposed to, which has been for us really reassuring. At the end of the day, like I said earlier, you're watching financial news, and everything is either the best it's ever been or the worst it's ever been for ratings. But we really try to focus on our data and kind of ignore the noise. Which I think we're actually giving a talk next week at the Metastock conference, and our title is Doubling Down on Data. And I think for us, it's just keeping an eye on all the different metrics that we're looking for. As you can see here with Keys of the Week, we like to stack multiple indicators, multiple metrics to all tell us what the market's doing and what direction it's going, historically how it's behaved. So while we haven't changed anything for our models yet, it's something that we're constantly reviewing because indicators stop working. As we're all, if you've been a trader for any period of time, you're looking at certain metrics, and all of a sudden there's a change in the underlying indicator of the way the economy is working, and you have to adjust. But so far, all of our indicators have, even with the increased volatility, have been behaving as we would expect them to with the way the economy's been going.
It's been a good stress test. I mean, our Asbury 6 turned negative on February 21st. Which I don't know if you can see my mouse, but it's right down here somewhere.
We can see your mouse, yes.
February 19th was the high. Now, it re-engaged about a week ago. So somewhere in this neighborhood here, it re-engaged. And as these, the ranges, the one thing about our models, which is really helpful, is as sometimes the ranges are really narrow, they kind of start to contract. And then there's other times, like this past month or two, the ranges are huge. We're up 100 today, we're down 100 tomorrow. And the models, we've got some components in the models that adjust for that. So we're not getting run over by an expansion in the range.
Okay. So down 100 in what tomorrow? I just need to write that down.
You talk to me after the close tomorrow. I'll give you all the information.
Yeah, you'll let me know. You'll drop me a text after the market close tomorrow.
Absolutely.
When we last spoke, you were talking a little about global flows and how Europe was outperforming the U.S. and particularly some of the strategic moves you had done that way. Have you seen a shift in those asset flows? What are your opinion? Obviously we're a month or two later now. How has your opinion shifted with the market?
It really hasn't. I'm going to see if we could actually. So we're going back into our research center here, and we've got a number of models, that you just saw me just kind of whiz by. But
yep.
The one that we talked about last time, it's U.S. versus the world, and what U.S. versus the world does is it measures relative performance of the S&P 500 versus 25 different global equity markets in 3 different time frames. And it does that for, it's a pretty good comprehensive set. Like we've got South America here with Chile, Brazil, and Peru, continental U.S., Western Europe, Asia Pacific. We've got the Middle East here. We have Oceania down at the bottom. And you could see most of the time, I should say, under normal conditions, the U.S. is outperforming the world under most conditions. When the U.S. typically stops outperforming the rest of the world is when the market starts to get tired, when the S&P 500. I first started seeing relative outperformance coming out of like Italy, Germany, Spain, back in the maybe second to fourth week of January, the latter half of January. Then it started spreading to more countries in Western Europe. Then it was a little bit of South America. It started moving to Asia Pacific. And now you could even see, UAE has been outperforming here also. So almost everything is outperforming the U.S. on a tactical and on a strategic basis. So this is one of those indicators. Most of the time, you're not going to see a lot of green and bold here because the U.S. under normal conditions outperforms. But in this case, we already knew, the Asbury 6, it turned to negative on February 21st. CPM followed a day or two later. So we already knew that our tactical indicators on the S&P 500 were starting to turn. And in the meantime, while that was setting up, we're starting to see Germany outperform, Spain outperform, France outperform. So now you've got a multi-dimensional idea of what's going on. And it told us, and it told our clients that if you want to be invested in equities, maybe this is a good time to kind of reduce some of your exposure here and maybe move some of it overseas to Western Europe. And maybe while the U.S. is in the doldrums at that time, we didn't know that it was going to drop by 18 or 19%, which the S&P did from top to bottom.
Yeah.
But we did know that there was opportunities overseas, and this might be a good place to reallocate some of that money until the sun came back out in the U.S. again, which it appears to be doing now.
Great. What do you think are, I'm going to ask you about sectors. Since you talked a little bit about your sector rotation models, what sectors are you looking at as strong right now?
Right now, we're seeing, there's a little bit of a flipping of the head of, we were very much defensively aligned and have been for a better part of the year. And funny enough, utilities has kind of been playing both sides of the fence. But right now, we're a little bit more offensively aligned with technology and communication services emerging. As you can see here on the table that we're sharing, consumer discretionary is starting to emerge on a weekly basis. Still kind of waiting for some of those flows to cash over and push through to get us a little bit more higher ranked on the consumer discretionary, but very much tech focused. I was looking at the QQQ this morning, and we're seeing net expansion and asset flows there, as well as starting to break some moving averages. I think we're still looming under potentially the 200-day, But tech's definitely leading us out of this if this rally continues.
Yeah, so note how this is, right? So we've got 3 different time periods here. And again, this is not based on relative performance. This is based on a mathematical algorithm that Jack and I built to measure how fast the money is moving into and out of these 11 sectors. You can see in energy, we have 11s all the way across. This is 11 sectors of the S&P 500, which if you put them together, they're the S&P 500 that are broken up into 11 pieces. So energy is the weakest all the way across these 3 different time frames. Look at technology. It's the 10th weakest in terms of the strategic, which is quarterly for us. But it's number 1 and number 2, respectively, in the trading and in the tactical time periods. So technology was wallowing down here through most of the big move down that we had, the scary move, that we've had here up until the beginning of April. Technology was right down here among the 2 or 3 worst. So residually, it still has a low ranking, meaning fastest money moving out. If you're looking out the quarter, but looking out the month and looking out the week, that money came piling into here after we bottomed on April 7th. We had some good up days. So now you see the market starting to shift again and jumping on the fast horses and getting off some of the defensive places. You could see it's running out of staples hard, which is a defensive place to go. Excuse me. And it's running into consumer discretionary and tech, which are typically where you want to be when the market's risk on. So that's kind of how that works together.
To somebody that subscribed to the reports, and if I'm looking at this and saying, okay, well, yeah, technology looks interesting to me, is the recommendation that they buy XLK, or would they be looking for specific stocks? What do you typically have a recommendation for that? Or does that just kind of point them in the right direction?
I guess the answer is both. So if you're trading CEF as a model, the top 3 sector, we rebalance this once a week on the weekend, and signals come out over the weekend to trade on the open on Mondays. If you're trading it as a model, you take the top 3 and you equal weight them for whatever you're purchasing. If you have $10,000, you're $3,300 in each of the top 3 sectors. So in that case, the recommendation this Monday would have been utilities, communication services, and technology as what you were purchasing for that allocation of money into the CEF model. Like I said earlier, when people are also trading CEF, we don't do individual equities at Asbury Research. We kind of focus more on the higher level
I like
ETFs.
that.
So for those managing their portfolio, what they can kind of see here is as technology has moved itself up the rankings over the last couple of weeks, they could start to maybe put on some more technology type trades, increase their exposure to the ones that they already have. And as they see things start to fall, as consumer staples has started to fall, they might reduce their exposure on those individual equities as well. We even have a couple of clients that use these models to trade some options as well, just to kind of understand how they can use the model. But again, if top 3 each week is how they're traded, if you're trading CEF as a model.
So if you're a portfolio manager and you're wondering, and you have a portfolio of stocks that you're putting together, if you see this kind of fast movement that's going into technology, what they might do, we work with a lot of RIAs, is they may pull up technology and list the constituents in the technology sector and rank them according to market cap from biggest to smallest. And then they may have their own criteria. Most of these guys have their own, they may be looking at trend lines or moving average crosses or Elliott wave. Who knows what they're looking at? Or they might be looking at earnings, forward earnings or whatever it might be. They all have their own tools, but this tells them where the money is going in the space. And then they could go to that place and they could apply their own overlays to. So this tells them it's kind of a big sifter, right? It helps them know what to avoid down here, and
Mm-hmm.
where to look for opportunity. And then as you go through the individual constituents in those sectors, they can apply their own overlays to pick their own stocks, but they're doing that with the advantage of knowing that there's aggressive money going into those sectors.
Butterfly has a good question I'm going to ask from the chat. He's wondering what happened to the CEF model during the week where there was a huge red bar and then a huge green bar. I think we all know what week he was talking about. But I think actually one of those was on a Friday and the next was on a Monday. But what happened? Was there huge fluctuations in the CEF model during the tariff?
In general, sector rotation has, especially 2025, has been extremely fast.
Okay.
So what we have seen and kind of really relied on is our tactical month and strategic quarter to anchor these particular sectors to try to avoid getting whipsawed on the trading week. So the reason we do have 3 time periods, and I know this is kind of answering that question, but a little bit more vaguely, but we use these two, the tactical month and strategic quarter, to build up accumulation and momentum in the asset flows to track. Because when we've tested just trying to use the trading week, you tend to get whipsawed back and forth quite a bit as money flows in and out of the different sectors. A lot of it having to do with news or things coming out of Washington. So this year it's been very fast. We will see a lot of trading week exchanges. You can see here, consumer staples as a 2, even though it's still relatively low because there hasn't been any long-term accumulations in assets. So this model is meant to be, it will lag ever so slightly behind. We might not catch the tip of the spear for a trend, but what we are going to do is catch the longer-term tail of overall trends for these different moves. So, and that particular week, if I recall correctly, a lot of those asset flows kind of canceled each other out. So on days, especially days where we have really big volatility in the markets, we'll see massive inflow of assets come in and then a massive outflow of assets. Oftentimes, not by a rule, but more anecdotally, those assets tend to cancel each other out in the way that we calculate the flows.
The way that sector rotation works, from my perspective, and we speak in metaphors a lot here. When I'm trying to explain to a client how this works and manage their expectations in a normal sector year, think of those 11 sectors that we're looking at as 11 horses that are all in a horse race together. So there's an 11-horse field. I'm not a horse guy. I don't know if there is such thing as an 11-horse field. But think of an 11-horse field, and once around the track, the race that they run is 1 year. In a normal, quote-unquote, normal sector year, those horses, those sectors generally stay in a pack all the way around the track, kind of like in a regular horse race. Most of the time, horse wins by, it may win by a neck, it may win by a length, maybe a length and a half, but generally speaking, those horses stay together. That's a normal sector year. In an atypical sector year, and where the CEF model really kicks butt, is when 1 or 2 horses break out of the pack and they win by 6 lengths or 5 lengths. We saw that in 2021. After COVID, the Fed came in and said, we're not letting asset prices deteriorate any further. I believe it was XLK and XLC. CEF outperformed the S&P by 20% that year because we were on those breakaway horses early and we rode them to the finish line. Then in 2022, the S&P was down 19.6 for the year. Our model was up 8.3, 8.2 something. So we outperformed almost by 30%. The reason we did is because energy broke out of the pack on January 20th, I think, of that year, and it stayed out in front until the end of June. And that allowed us to, I think, during that 4 or 5 month period, XLE outperformed SPY by 40%. S&P was doing this, and XLE was doing that. So this is not a And the rest of the years where everything stays in a pack, it's generally a few percentage points on either side of the S&P with slightly lower risk. So this is one of those. So this particular model adds alpha to the portfolio, but every year is not a breakaway year for sectors.
In your opinion, I like your analogy. I don't know. I'm not a horse guy either, so I can't answer the 11 horse question. But you had mentioned a typical year versus an atypical year. What percentage of years do you think are a typical year? Out of 10, how many typical years are you going to have?
Well, let's see, going back 6 years, we've had 2 atypical years.
Okay.
But the important part is the 4 that were typical. And again, we see this as a sleeve in a portfolio. This is most investors have a piece of their portfolio that they keep in the market all the time. Most of the people that I've come across, certainly money managers, can't go to cash. They have a mandate. They may have to be 80% invested at all times. No one's going to pay a manager to be in cash. It's kind of like I'm paying you to do something. So this model is the dynamic replacement for that part of your portfolio that stays in cash, or that stays in the market rather. But instead of buying the S&P 500, or instead of buying the S&P 1500 and keeping it plain vanilla, and that's that piece, maybe a 30-year portfolio that you always keep in the market, so you could capture the market, whatever it's giving you for that piece. This is dynamic. We are only moving into the top 3. And again, over those years that were not spectacular, that all the horses stayed together, so to speak, it's usually within 1 or 2, 3 percentage points in terms of the annual performance, either 2, 3 percentage points either above it or below it, with slightly lower maximum drawdown. I think the maximum drawdown is 4.5 to 5% less, and the beta is lower. So this is kind of like that piece that you keep in the market, and then on the other side, the CPM. That's the dynamic stock and bond portfolio. So we're moving back and forth between stocks and bonds as market conditions dictate.
All right. Butterfly says he likes your horse analogy, and he wants to confirm that it updates weekly and not every day.
It's weekly, yeah.
Yeah, it's updated once a week. Otherwise, it'd be way, way too jumpy. So in order to slow it down, it's every week. So we're capturing every week's velocity of asset flows in 3 different time periods, and we're displaying it on Saturday afternoon.
Cool. I want you. I know you guys have like a hard exit pretty soon, but I wanted to kind of just go back and kind of talk a little bit about the models that you've got and who you would feel is the best investor for those. So we talked about the CEF model. We talked about the CFM model. Can you kind of just go through the reports that you offer and kind of who you think is kind of the best investor or trader for those?
Sure. So we talked about CPM and we talked about CEF. And then we looked a little bit at US versus the world, which tells us globally where we are versus the rest of the world and when there's opportunities overseas. We have another model. It's CARP. CARP is an acronym for cross-asset relative performance. CARP tells us domestically where the outperformance is. Is it stocks or bonds? Is it growth or value? Is it large cap or small cap? Is it US or emerging markets? Is it technology or is it the Dow? So all of these are meant to be tools. We have another component, let's call it, that basically picks. It's a trading model that chooses ETFs to buy based on 3 factors: based on trend, based on asset flows, and based on relative performance. So there's all these different pieces, and so when we're managing money, we have 4 portfolios that have different risk-reward profiles that we use. But for if you're in the research business, you have to put enough tools in there so you can satisfy a lot of different people. So they're meant, like, most of the time you're not going to use US versus the world. Why? Because the US most of the time is outperforming the rest of the world. So when it's apparent on the model, we stay in the US. But man, those times that, like this past couple of months.
Oh yeah.
You said it yourself.
It's impressive, yeah.
WP, which was Spain or something, when the market, when certain conditions come up, while the rest of the country is getting their head beat in, hanging on to the S&P 500, you can jump over to another continent for a month or two and hang out and maybe make a little money while the U.S. is trying to heal itself and get going again.
Butterfly also wants to know if you ever look at metals and minerals.
We do.
Yeah. So one of the things
that was an answer that surprised me. I didn't think you did. So
we have a Substack report. We have a free Substack, and then we also have a premium one. But at Substack.com, we have this table that we call the SORT report. And what the SORT report does is kind of a top-down approach to figuring out where we see opportunities. And one of those components is commodities. So we'll look and see when we start to see some trends in commodities starting to, whether it's outperforming the broader market or we start to see asset flows into those particular ones. That's when we kind of start to dive into the individual metals and minerals. It kind of coincides a little bit with our ETF trade ideas, which, we were long gold for a bit, as well as silver miners. Yeah, we do a little bit of mineral stuff. We try to be topical. We try to kind of let the data point us in the right directions when there's opportunities, whether it's foreign markets or minerals and mining.
So Jack has built screens, and we run these every morning. And I'm probably going to get the details wrong, so feel free to correct me. But these screens. Talk about the 6,000 ETFs that we screen every morning for special criteria. And once we get these, as soon as I hit my desk at 6 a.m., I am looking at these reports that spit out of 6,000 ETFs, which have positive trends, which have positive relative performance versus their benchmark, which have AUM characteristics. There's money going into those, expanding money into those. And
yeah, so I call it the triple screen. So I get up extra early every day. We scan over 6,600 ETFs for various characteristics, trying to figure out what's outperforming, where's money flowing to, and what has positive price trend. Part of that subset is a commodities list. So we might have 50 or 60 commodities, and we're really looking for those commodities to have all three characteristics: price, trend, and assets under our AUM positive flows. And then from there, we use our technical background to find chart patterns, look at resistance, look at support, and
risk reward. To make sure that we're risking this much to make that much.
So we use the screen as, I guess, wind to our back, and then that's when we finally go to the price chart to look. So we've been, over the last couple of years, very much less focusing on price to select our ETFs and using more ancillary indicators and things so that, you can get a little bit cross-eyed when you're just staring at price charts all day.
So we've been in and out of gold 3 times this year. We've made money all 3 times. GLD is what and the reason that we looked at GLD was because of that screen. Got up one morning and GLD was in that short list that met these 3 different criteria that we needed to give it a look. Then I look on the chart and see if I can buy it off of a support level. I think for people watching, the last thing that we do is subjective, and really the only subjective thing that we do. Everything else is data driven. But I want to know, if I'm buying something, I want to know where my risk is right away. And it's not just an arbitrary 3 or 4%. I want to buy off of a support level. I want to buy a breakout. I want to buy somewhere around a key moving average or a trend line so I can limit my risk. If it tells me to buy gold, and gold is right in the middle of nowhere and there's no support there, there's no resistance there, anywhere close, I'm just throwing a dart there. So I will pass on that trade. The last and most important part of putting these ideas on is finding some risk reward. And I think that's just experience from me doing it a long time.
Another question we have is, do you look at TLT?
I do. It's been kind of boring.
I'm not surprised now.
Yeah, so we actually look at TNX along with TLT. TNX is the CBOE 10-year note index. And what it is, it's a blend of maturities on the 10-year note that effectively gives you, it's not the cash yield of the current maturity, but it's a blend of maturities. And I always want to know what rates are doing. I want to know what the dollar's doing. Jack pointed out to me, right, me doing this for 40 years, hey, Dad, well, did you know that for the past 5 years, UUP, which is the dollar ETF, has had a tight and stable positive linear correlation to the S&P 500. So the dollar's been getting beat up lately, and it's sitting on some huge support levels. We're watching that level in UUP. If that gets broken and the linear correlation stays intact, that could be big trouble for the S&P 500. That could correlate with something where China, in the U.S. just say, listen, we're not going to be able to come to a conclusion of this. If we have 100% tariffs in China, there's going to be bare shelves here, in a couple of months. So there's still a whole lot of stuff that could go wrong. And looking at the dollar for kind of an indirect indication on what might happen to the stock market right now is a smart idea based on the statistics.
Do you have any daily morning reports?
Not at this time. All the stuff that I'm running in the morning is purely internal, and we distill it down, and it seeps into our other reports for sure, and our trades and how we build our models. But currently, I'm keeping those morning scans to myself.
How much time do you guys spend on any given day working on research reports? Out of curious.
Some days we don't write anything, and all we're doing is looking at coming up with ideas. We're building new models. We're building a new model now that is a variation of CPM that's going to be an alpha generator. CPM got out of the market, went to Bill, so to speak, on whatever it was, February 22nd, pretty close to the top. And we, at one time, I think we had 16%. If you're looking at that as kind of a short idea, we had captured 15 or 16% all the way down to the bottom there. So we're always looking at, some days we write reports all day. Today's one of those days. When I get out of here, I'm going to be writing, I'm going to be doing the new version of the report that I showed you. And a lot of days we're just doing research and coming up with new ideas and building new models.
Right on. You guys have been very, very generous with your time, with your research, all of that kind of stuff. I wanted to put your stuff up on the thing again. www.
Yeah, it's Substack. What is that? Asbury Research.substack.com. If you like the way we look at markets, we've got we have a free Substack. We also have a YouTube channel that you could subscribe to. It's Asbury Research's YouTube channel. Lots of videos there. We post stuff. I do it twice a month. A podcast about 25 or 30 minutes where we look at a lot of different markets. We look at the stuff we do. So yeah, you're more than welcome. Hopefully you could learn something and something that'll be of interest to you and help you in your trading.
Thank you, guys. Thank you, John. Thank you, Jack. Always great to have you. I appreciate it.
Yeah, it's nice being here, Jeff. Thanks.
All right. Very cool. And of course, we are the Traders Forum. You can join us at the at thetradersforum.com. Thanks, everybody. If you like the video, like and subscribe. I'll see you at the forum. Thanks, John. Thanks, Jack.
Later. See you next time.
Have a good one.